Thank you, Jean. Good morning, everyone, and welcome to our educational workshop on financial stewardship for small nonprofits. We are the Pacific Hospital PDA. Our grant-making program is the Health Equity Fund, which is probably where you know us from. If you're here, you've either applied for a grant or you are a past or current grantee with us. And we are doing this presentation in partnership with Greenwood Ohlund, who are experts in financial stewardship and will be presenting with us today. And so before we start officially, we'll go into some acknowledgements. We acknowledge the land on which we are meeting, the ancestral lands of Duwamish, Muckleshoot, and Snoqualmie tribes, and recognize their continuing connection to land, water, and community. We honor with gratitude the land itself and the Coast Salish people who are still here today. We recognize the systemic oppression of Indigenous people, enslaved Africans, and other historically exploited people, which has led to the disproportionality in representation and disparities in health of these communities we serve. Okay, so as Jean instructed earlier, and as you can see in the chat, we'll have you introduce yourselves with your name, your org, where you are. Please keep your microphones muted. If you have questions that come up during the presentation, you can go ahead and put them in the chat, and we will get to them after a Q&A section following every section here. And we wanted to make this environment, free of judgment and allow you to, be vulnerable if you're willing to. So we like to remind you that what's said here stays here, but keep your learnings and, share those out. And as you can see, we are recording this presentation today. And following the presentation, we will send you this video as well as slides, anything that's important in the chat. For questions that you may have had that were answered during the presentation. Next slide. At the Pacific Hospital PDA, our mission is championing health equity. We support and provide funding for the provision of the best possible healthcare in the Puget Sound region in an effort to eliminate disparities in access to health resources and improve health outcomes. So that is who we are at the PHPDA. And who are the people? Well, myself, I'm Mallory Fitzgerald, the grants manager. Jean Yoon has introduced himself. He's our communications manager. We have Whitney Regan here in the room as well, our office coordinator, our executive director, Virgil Wade, and I'm going to turn it over to our associate director, Christina Bernard.
Good morning, everybody. So as a lot of you know, we started doing these learning sessions about a year ago, and we've had some others focused on grant writing and evaluation. And we knew from the beginning when we started this that we would probably have one on financial management, pretty early in our process. We have a wide range of grantees from really large established multi-million-dollar organizations to very small new nonprofits that are just starting and just learning the rules about nonprofit management. So we wanted to hold a session more specifically focused for the latter group, though we do think there's going to be some good tips and learnings here for people from larger organizations, especially newer people at those organizations or ones who might work on the program side and know less about financial management. And as with all of these sessions, this is certainly aimed to give you some tips and some information that's going to be helpful to you more broadly in your financial management, not just related to our grants. So a little bit, next slide. A little bit about our main presenters. So when I started working at PHPDA all the way back in 2010, we had also just hired a new accounting firm, and we're working with a new person who had recently joined that firm, Greenwood Ohlund, and that's Amanda O'Rourke. And especially in my first year or so, as we were doing a little reorganizing and cleaning up of our financial management, Amanda was a great resource to me and the PHPDA generally. And over these 13 years, Greenwood Ohlund has continued to help guide us through, changes in what we do and changes in accounting rules. We've grown, and so have they. Amanda herself is now the managing partner. And I know based on what we see in grant applications that their practice has grown a lot, because I've now started seeing a lot of attached audits that are conducted by Greenwood Ohlund to a lot of our grant applications over the last several years. But our financial management remains strong, and Greenwood Ohlund does our bookkeeping and accounting for us. So when we started thinking about having this session based on financial management and stewardship, Amanda is the first person I thought of, and she happily agreed and recruited a few of the other partners from the firm to co-present with her. So with that, I'm going to pass it over to Amanda, Jason, and Andrew to talk a little bit more about what they each do, and then to lead us through the session.
All right. Thank you, Christina. Can everyone hear me okay? Yes, great. All right. Well, yeah, I have been working with PHPDA for, I cannot believe, 13 years, and have been the managing partner at Greenwood Ohlund now for 5. But I got my start in nonprofit accounting when I was in college. My first internship was for a grassroots nonprofit that taught photography to refugee kids. And they hired me as their unpaid intern to maintain their QuickBooks file, which now 20 years later is terrifying to think about what I was doing in that file. But I got the bug for working with nonprofits back then. That was in 2021. And so I'm really excited to be here today to talk to you all about financial stewardship. And I'm also very grateful to my partners, Jason and Andrew, who are also here to co-present. And Jason, do you want to give your bio next?
Sure thing. So my name is Jason Mallon. I'm a CPA, and I'm a partner of the CFO and Accounting Services Department at Greenwood Ohlund. I've been in accounting for the last 20 years. I spent about half of it in CPA land, which is what I like to refer to it. And the second part of that is actually in private practice as a CFO of an independent school in the Bellevue area. So I will be talking later today about an actual case study, and I look forward to hearing your questions and discussing financial stewardship.
Perfect. And I'm Andrew VanNess. I've been doing nonprofit accounting and auditing for about over a decade now. I am one of the partners, one of 2 partners in our assurance practice. I've probably done a handful of those audits Christina mentioned that you've seen. And so, yeah, I've been at Greenwood Ohlund for about 3 years. I was at another firm for 7 years or so, and then I had a little taste of private accounting in between. But I'm back in CPA land, as Jason calls it. So
it's a fun land.
Exactly.
All right, and just a couple things about Greenwood Ohlnd. We're a single firm office. We have about 30 professionals. And as you can see from the 3 of us presenting, we are a traditional public accounting firm. So we offer tax, audit services, and client accounting and CFO services. And we very much have a specialty in the nonprofit sector, which is why we're here, and very grateful for that. I am going to walk through our agenda for today up on the screen. We're going to start a little exercise to get everyone's creative juices flowing, if that's a thing in financial stewardship, and always, and talk about what financial stewardship means to each one of you. I'll explain that exercise here in a minute. And then we have 4 main sections that we're going to go through. The first one is considerations for accounting, finance committees, and boards. And Jason is going to lead us through this discussion. The next one is building a strong foundation in budgeting. And that's going to be me. The third main section, 4th on this slide to be confusing, is your first audit, how to prepare for it and what to expect. And that's going to be Andrew. And then I will wrap it up with the Form 990 and why it's more than just numbers. From a housekeeping perspective, we're going to ask if you can keep your questions till the end of each of these sections. So Jason, Andrew, and I have a slide built in at the end of each section where we'll welcome questions audibly or over chat. If questions come up while we're presenting and you think you're going to forget it, please just drop it into the chat. Christina and the other folks at PHPDA are going to be monitoring the chat and make sure that we see and answer those. And then I've got a slide at the end here with our contact information. So if we can't answer all of your questions in the 90 minutes that we've got together, then please feel free to email us and we will try and get those answered for you. All right, I'm going to stop sharing my screen and Jean is going to lead us in a word cloud about what is financial stewardship. So if you think about what financial stewardship means to you, we've got, Jean's going to put a link here. I can't see if it's already, yes, there it is. There's a link in the chat. And if you can click on that link, this is what the screen should look like. And you enter a word with that, what financial stewardship means to you. And we're going to watch this word cloud build on the screen. So we're going to just give this exercise a couple minutes. I'm going to put myself on mute so I'm not distracted while everyone centers themselves on financial stewardship.
Good morning, team. I just got onto the call, so good to meet all of you. Hope I didn't miss a lot.
Good morning. No, you did not. We just introduced ourselves at the PHPDA and Greenwood Ohlund. If you see in the chat, you should see a little Menti link. So please go ahead and click on that. And it will be prompting you to choose 3 words on what financial stewardship means to you. And then it will be showing up on this screen collectively. So please, thank you, Valerie. It's in the chat now. So please go ahead and click on that link and then we will continue our presentation.
What link? What is the link? Can you say it one more time, if you don't mind, please?
Yeah, absolutely. It's in the chat. My name is Gene. It's in the chat, menti.com, and then with some random letters and numbers. I think there also is a QR code somewhere, if that might make it easier. Oh, thank you, Valerie. Sounds like Mallory is going to try to support from the side.
And I think, Jean, correct me if I'm wrong, but if multiple people put the same word in, then it gets bigger. Is that right?
Assuming the spelling's the same, yes.
Yeah, assuming the spelling is the same and they're not using a synonym.
Right, right. Well, efficiency, I love that that's right in the center. It's speaking accounting language right there. All right, fun. Well, thank you everyone for participating. Hopefully you got a chance to enter your word cloud in here. I'm just going to get my slides pulled back up.
I love the transparency. That's great.
Feel free to continue inputting it in with your words, and then I'll do a screenshot and share it with everybody at the end. But please go ahead and continue the presentation, Amanda, whenever you're ready.
Okay, perfect. Well, yeah, financial stewardship has a lot of definitions. We're gonna, focus on 4 things today, but we could talk about the different aspects of this for days. We've got one more exercise to encourage some group participation here. Let me get my slide shared again. And that is a little show and tell. So this time we're going to ask for people, if you're comfortable, to you can unmute and add some commentary here. We're curious as we get started what current challenges you all are facing in your organization. And this is not necessarily meant to be limited to financial, just challenges in general to help us understand the landscape that everyone is working in right now. So if anyone feels comfortable sharing, now's your time. And if not, I have a slide, so don't worry.
Yeah, I guess I can share real quick. For Yeti, it's about segregation of duties with like small staff teams. It's like something that's really difficult for us. And then also like knowing when to invest in the next part of like, oh, now we should have a bookkeeper, or now we should have that audit. Like, what are those threshold moments?
Oh, it's like you planted that question for Jason. That's exactly what his presentation is about. Thank you.
Well, and Andrew. So I love it.
Yeah. Anyone else interested in going off mute and sharing?
I see someone dropped affordable benefits in the chat. So,
Yes.
and adjusting to growth. And I'll say adjusting to growth as a grant maker, that is something we see as a real challenge for a lot of our grantees, is adjusting to growth.
Yep. Well, and affordable benefits is very timely, as I'm sure many organizations are going through benefit renewals right now. All right, well, I will share this next slide, which is, so this is from an April 2023 Forbes article that talked about what are the emerging trends that leaders should be watching, and Forbes list nonprofit leaders, that is. And Forbes listed out this list of 16 emerging trends in the nonprofit sector. So this is a lot of, I'm not going to read the list. I'm just going to leave it here on the screen for a minute. But there's a lot of considerations and a lot of things that are changing really rapidly in the sector. And so financial stewardship, there's an impact, you know, across a lot of these trends, and some of them we'll touch upon today. But the purpose of this slide is just to recognize that, you know, we're talking about a very small portion of everybody's jobs in terms of financial stewardship, and recognizing that there's a whole lot more to running a nonprofit organization.
Well, and just to kind of jump in real quick, the first two line items, you got need for staff resources and financial support, alternative staff to options. We've already heard people kind of discussing that. That all flows into your financial projection, your budgeting. And then even 15 and 16 at the bottom, where you have mental health mindfulness, flexible work options, that all flows into affordable benefits. And as you are adjusting to your quick growth, how can you massage those categories to help really ensure the long-term sustainability of your organization?
All right, Jason, with that, I'm gonna turn it
Can
over.
I ask a quick question here before we proceed?
Sure.
Is that yeah?
Yes, please.
Is this recorded, or can we record it so that we can
Yes.
follow through?
It
It
is
is
being
recorded.
It's being recorded, and you'll get a link to the slides and the recording afterwards.
Yeah, sorry I was late, but thank you so much. Appreciate it.
Yep, no problem. Okay, so thank you, Amanda, for passing the baton over to me. I have section 1, considerations for accounting, finance committees and boards. If you could go to the next slide, Amanda. I like to keep things very simple. So this is my only slide. And so I'm going to be talking about something that's near and dear to my heart, because when I'm thinking about you know, the current economic environment, the current environment that small and medium-sized entities are dealing with, there's a whole host of uncertainties. We're coming out of a post-pandemic environment. How is that going to impact operations? You know, you have the Federal Reserve increasing prime rates right now. It's currently sitting at about 8.5%, which impacts your debt structure potentially. We have conflict all around the world right now that may have an impact materially to your communities at home. So how are you dealing with that? And then lastly, you hear a lot in the financial world a discussion about recession, and is there going to be a recession in the near future? Who knows? These are all uncertainties that any small and medium-sized entity organization needs to be thinking about on the regular that all flow up into your accounting processes, your communication with governance, and just ensuring the long-term financial sustainability of the organization. And when I really think about financial stewardship, what I think is, I'm not thinking 1 year down the road. I'm thinking 10 years, 30 years down the road. I'm trying to envision, what does this organization look like in 30 years? And so you really have your strategic plan, but as a offset of that, you have your strategic financial plan as well. And you really need to make sure that those two items jive together and that they're communicating with one another on a regular basis to ensure that there aren't any missteps by the organization. So the case study that I'm going to present today relates to me actually jumping into private. And so when I jumped into private, it was in July of 2015. And the prior CFO actually had gotten walked out the door by leadership because of their inability to properly plan for the future. And this really takes me to my first bullet point: financial team expertise. It is a pillar of an organization to have the appropriate firepower for your accounting department to ensure the long-term sustainability of the organization. Now, what does that even mean? And unfortunately, the answer is it depends, like a lot of things in this world. But at a minimum, when I'm thinking of small and medium-sized entities, I'm thinking about, about $1 million to $5 million. I know there's some organizations here that are under $1 million and just starting things up. So you're not going to, be able to have an organization where you have overhead costs for an accounting department of $500,000. That's just not feasible. And so how do you structure your accounting department in a way that ensures proper accounting and the ability to make proper decisions? I find it interesting, that Christina, in talking about her experience, says, hey, we had to reach out to Greenwood and talk about how do we clean things up 13 years ago. That happens on the regular. And it's because, generally speaking, if you don't get the right people in place on the accounting team, you're garbage in, garbage out. And so, you have a lot of these accounting softwares like QuickBooks Online that are designed to be intuitive and that anyone can use it. That's just not the case, because there is accounting theory and how it is structured with the balance sheet, income statement, cash flow statement. You really need to understand the underlying theory to properly use the accounting software. And that's where your financial team expertise comes in. So, what are some kind of benchmarks to kind of think about? When you're an organization of between $1 and $5 million, I think at a minimum, you should have a controller in place that knows exactly what's going on. Okay. Now, I know you may not be able to afford that, but what you may be able to afford is a full-time staff accountant. Maybe even you're running a bare bones operation, and you have just an operations manager that's inputting the daily transactions. Then you have someone coming over the top with part-time CFO services or something like that to be able to provide that additional layer of financial acumen so that you can make proper decisions and discuss items with the finance committee, the ED, the board on a regular basis about issues going on. And so going back to my example, when I came into the independent school, even though they had a CFO that didn't actually understand accounting. And that wasn't known until it was too late. They had already made a decision and implemented the decision to go out and acquire a new building without doing the proper due diligence. And so that, even though they were hitting on their strategic plan, they hadn't done proactive enough work to ensure that they were sustainable for the long term. Again, going back to that fiduciary capacity, and working through financial stewardship. So first piece, really financial team expertise. And again, you may not have the budget. So you get in a staff accountant that actually has accounting background. I think you need someone on the team, whether it's in-house or at the finance committee level, that has either a CPA background, CFO background, that can help lead and maybe even jump down into the operational weeds a little bit when it comes to planning and doing your 5-year projection or things of that nature. So in talking about the example of the school, they had made this decision, okay? And they said, hey, we had, $2 or $3 million at the time. Great. One of our strategic objectives is to secure our forever home. And so they went out and utilized the majority of that cash to help purchase that building, but they also financed the other part of it. And so we're leading into the next example is they didn't do any sort of cash burn or cash projection of what this is going to look like in the next year or 2 or 3. And so some of you may go, okay, what is cash burn? The easiest way to think about cash burn is how much money do you have left over at any given point in time to fund operations into the future? And so when I started, there was an actual interim CFO at the time. And she told me, hey, you're going to want to go and do a cash burn. And so that to me immediately set off alarm bells in my head telling me, okay, something's going on. And so I started July of 2015. By that August, I had worked out a cash burn, cash projection. Come to find out, we only had enough cash to make it through February of that year. So February of 2016. So that really went from being proactive to reactive. And I was like, okay, we need to make, changes right now to the income statement structure, the balance sheet structure, and ensure the long-term sustainability, really taking that financial stewardship thought process and utilizing it for the next 6 months. And so when you're looking at cash burn, when you're looking at cash inflows and outflows, there's really a few items that I want to highlight that need to be thought about or discussed when doing these sort of exercises. The first one I'm going to bring up, it's the most common one I hear. And while it's important, it's not the only piece of the equation. So often I'm hearing things of, oh, we need to cut costs. We need to, trim our operating budget. Where can we save on some expenses? And too often that's the only focus. Instead of, and so when that is the only focus, and when you can cut expenses on the operating budget, what ends up happening is you may unintentionally create additional burden on your remaining team members. In addition, you may be reducing the value of the services that you're actually providing to your community. So it's really a holistic view of not just looking at the expense side of things, but you also really need to take a look at your value proposition. And what do I mean by that? I mean, what are you charging for services? What are you asking for in a grant application? Is that going to meet the necessary needs for your organization to operate how it needs to? And I feel too often we're so scared to actually define our value as an organization, as a community. And so I really want to highlight that. At the school, one of the things that we did was we took a really deep dive into our tuition structure. And one of the things that came about that exercise was we weren't pricing to our value. We would say, hey, this school doesn't provide the benefit that we do, but they're actually charging more money. Well, that's out of whack. And so your expenses may be out of whack, but you really got to look at your revenue too, to make sure that that's where it needs to be. And so what we ended up doing was we increased tuition 20% year over year. And to some people, you know, that's like, wait, what? And you know, when we brought this to the finance committee and board, there was a lot of intense discussions about whether this was the right move. Well, it was the right move, and it helped us move forward. You know, something to think about is when you're talking about your value proposition, are you increasing pricing every year? If you're not, then you're falling behind. I know I'm working with an organization right now where their lease costs are going up 10%. Their payroll costs, their adjustments are wanting to be 3 to 4%, yet they're not willing to charge more for the services they provide. So they're you know, behind the 8 ball already in dealing with that. Because once you go, hey, well, you have all of these costs increasing, aren't you going to also increase the price? And they're like, well, no, we can't do that. And that's a great example to me about not being able to properly value the services to your community. So sorry, I just got distracted by the note. The other piece that is really a common issue that I see as it relates to cash burn relates to the debt structure. In the example I provided, the independent school, again, they took a significant amount of cash as the down payment, and then they financed the remaining portion. I've seen this multiple times, and this is not like an uncommon occurrence. But what this ended up doing was it eliminated their operating reserve. It made sure that they couldn't operate in a worst case scenario environment, which they saw when their enrollment went down. And so you have to really do some due diligence in figuring out, okay, hey, if we make this decision under worst case scenarios, are we going to be able to continue to operate? So just kind of wanted to lay that out there. Throughout this discussion, you're hearing me talking about communication with the ED, the finance committee, and the board. That's extremely important. And that goes back to the transparency. You have to ensure all of your stakeholders are brought along for the ride, even if it's news that you do not want to hear. I mean, I remember going in and telling people, hey, we have cash until February. And that's a hard pill to swallow. But it also allows you to, at that point in time, go from a reactive environment to a proactive mindset where you're really going, okay, how do we adjust this? How do we get through this? And so for me, a part of what is important is putting into place structure. Some of the word clouds you heard was transparency, segregation of duties, things of that nature. That's what accounting is about. Accounting is about putting in structure, so you're periodically looking at things on a timely basis. I know Amanda is going to be going into this more in a few minutes, but talking about key performance indicators, strategic financial projection, you really need to put together a 5-year and or a 10-year plan that shows, okay, this is what I'm expecting over the long term. And on top of that, you want to not only go, hey, this is what we expect in kind of a conservative estimate, but you want to do it in a worst case scenario as well. Too often when I see people putting together a budget or a projection for the future, they're like, oh, you know, we're going to cut down on costs here and here and there. What ends up happening is they're too liberal with cutting the costs, and realistically, they're not appropriately budgeting. So you really want to budget to a worst case scenario to ensure you can meet the obligations to the community to ensure the long-term financial sustainability of the organization. You know, I only have a few more minutes, so you know, I'm open to questions now. But from my perspective, the top 3 takeaways is ensuring appropriate firepower in the accounting department. 2, properly doing due diligence as it relates to your strategic plan, with utilizing KPIs and your 5-year plan, which is periodically reviewed a couple times a year. And then finally, providing that information in a timely basis so that all stakeholders can appropriately make decisions when they need to. I've seen situations where you have an accounting department that doesn't keep their books updated for half the year, and then they go, oh my goodness, we don't have any cash left. And that doesn't allow you to be proactive, it's reactive. And so again, ensuring an appropriate accounting staff, due diligence, and timely communication. Any questions right now?
All right.
Okay.
Well, if burning questions come up, we'll have some time at the end here also. Thanks, Jason. So piggybacking off of that, I'm going to talk about building a strong foundation. And in this case, it's budgeting. I have seen organizations in my 20-year tenure that don't have a budget, which is a huge red flag. And, you know, I've sat as treasurer on a number of boards, and should an organization come to the table without one, I can't join the board. I mean, it is the slide says it all. It is the foundation to financial stability and sustainability. It's how the board can monitor and keep folks accountable and transparency to the organization. And also it helps ensure that the organization is fulfilling its mission. This is, I know I'm stating the obvious here, but it's the nonprofit sector is not about profit, and it's about a mission-driven purpose. And so having the budget align with that mission and tying it back to the strategic plan of the organization becomes really, really important. So the first recommendation when starting the budgeting process is to make sure that you're involving all of the key stakeholders. In some cases, you know, we get a narrow focus of only involving program managers, for example, but making sure that you're involving different board members in the process to help ensure, you know, poking holes in thought processes that have maybe been carried through the organization for a long time, and also making sure that it's tying to that strategic plan. So, you know, I've gone into budget meetings before, and, you know, I'm the person that nobody wants in the room sometimes because I'm asking questions about how some expenses are tying back to the strategic plan, or how some of the revenue categories are tying back. So it to me is really important. It's an important building block of the process that you can identify how those things are aligning to support the mission. And also encouraging the use of historical data and trends. So that can be looking at your actual financial results for a number of years to help inform it, and also outside trends. I'm going to talk a little bit during this presentation about my use of ChatGPT, which is my new best friend. And it's such a great tool. You know, it can be in the budgeting process to go out and do some research about trends in the sector and different things that you're looking for more information for. So I think this is all really relevant in the context of budgeting.
So Amanda, how often when you're going through the budgeting process are you actually reviewing actual data during the year?
I mean, I encourage it to be at least every other month. I think it, you know, going back to your point, it depends on the manpower of the accounting department, person power of the accounting department. And, you know, what the resources are, but I would say it's ideal if it's at least every other month. You know, if you get into every quarter, you can, by the time you're reviewing it, it can be too late to take some action.
And are you talking about at the finance committee level? Because for me, from an accounting perspective, I'm thinking we should be doing monthly. 15th to 20th of the day by the close of the month, just to see at the actual organization level how are you doing and are you tracking, so that you can talk to the finance committee and board as it relates to that. I always think it's interesting. Amanda made a great comment where she's like, you don't want me in the room. That's exactly who you want in the room. The person that is going to ask those tough questions.
Well, and I, right now I serve on the Mountains to Sound Greenway Trust as their treasurer. I use some of their info in these slides, and our finance committee meets every other month, as an example. And so, some of it is just kind of driven by meeting cadence in that case. But thanks, Jason. Good question. So this slide is just a list of different sources of income. I just wanted to reiterate, I like to build a budget starting with revenue, and this is can be a personal preference. I believe in zero-based budgeting, meaning that we don't want to budget for a deficit if we can avoid it. And so we at least want to get to a break-even budget. And I think one great way to start that exercise is to start with revenue, to understand what revenue you've got slated for the upcoming year. And then you can build out your expenses from there, and making sure that you've got these different buckets of income within your budget. Grants, gifts, program revenue, and special events tend to be the most common. And then also breaking that out between restricted and unrestricted, the fund accounting, which makes nonprofit accounting so much fun, should also be part of this build out. And then I wanted to highlight that investment income should be separately stated. That's usually a below expenses, so that you can really draw attention to what your operating revenue and expenses are before you get investment income included. And then for expenditures, I list. Oh, sorry.
I just ask a quick question about the grants and the budget. Do you factor grants that have that you anticipate to be awarded, or only grants or that you have been awarded? Because my fear is that if you factor grants that you've written and you expect to be awarded, you are confident that this grant will be approved, but you're not sure.
Yeah.
If you factor that into the income for the organization and you budget on that, and come a month or two or down the line, the grant is not approved, that might result
that's
into
a really great question. I think so. My opinion on that is, let's say historically your grant income has been 300,000. Maybe you vary year to year, 300, 350, something like that. And in the following year, you're planning to apply for 600,000 in grants, for example. I would try and apply some kind of probability to it. If you think of that additional 300,000, you've got a 50% probability, then I would include half of that in the budget. So you could budget for 450,000 in grant income in that year, splitting the difference with your applications, if that makes sense.
Yeah, it does. I'm just thinking to the extreme. I'm thinking, let's say you have 2 grants for small organizations. You apply for 2 grants, they probably be 500,000 or 300,000. It's only 2 of them, and you factor them into your annual budget. And unfortunately, which is very possible, it may happen that all the 2 grants don't get approved. They're kind of they are not approved. So you lost that anticipated income. You're not going to get that as real income. And you've already done your budget, it's approved by the board, and you are going to start hiring staff or planning for the year. Now what happened? I mean, is that good practice, or what from your experience?
I mean, I think it goes back to what Amanda was saying about probability analysis, and also looking at worst case scenario. Don't count on money until it's actually in the door. Right. At least from a budgeting perspective. And so you got to be, from my perspective, from a financial background, I'm very conservative and I don't count it. Again, unless you can show some historical trend and you feel confident that it's going to be coming through. But Amanda's right. She's talking about looking at past history to help guide where you're going in the future. So if you're applying for 2 new grants, what are the chances that you'll actually get it?
Yeah, and I would say that's a perfect segue to this next slide, which is about expenditures and how we budget for expenses. I think when you have grants pending application, you're not sure if they're going to be awarded. I would also encourage those expenses to be pending, right? So you have certain expenses that even though they're in your budget, you know that if X grant is not awarded, those expenses are also not going to be expended. So if you've got any more questions, let's save those till the end. I just want to make sure I get through these slides and then I'll be happy to answer. So
Oh,
I
thanks.
so I put on here 2 ways to think about expenses. I feel like I made this word up, categorical. It's not a word I use every day, but here it is. And that's thinking about the types of expenses. So employee expenses, usually the largest bucket of expenses for most organizations, outside services like contractors or consultants, professional development. So there's these considerations of categories of expenses, big buckets of things for you to organize expenses. And one point of caution here is accountants never want to see an unnecessarily long trial balance. So you want to try, meaning, you don't want to have an expense line for meals from Chipotle and meals from wherever. You want to keep your expense categories as concise as you can because it makes your reporting much more digestible. And then the other piece of this is the functional expense. So each category can be spread across these functions of, I'm sure everyone has heard, program versus administrative versus fundraising expenses. And I'm going to talk a little bit more about those ratios, but these are the important considerations. The building blocks of expenses is that they fit into both of these things, a category, and then a category can be split between these functional pieces. And just a reminder that the administrative expenses, we always want to make sure that those get allocated across program. So there's an admin allocation that we encourage organizations to calculate and record on their financial statements so you can get a really true sense of how much a certain program is costing. And hopefully this is music to the grantor PHPDA's ears here, because when they are looking at grant applications, this is one thing that they're considering is what is the actual cost to run some of these programs? And that will include a portion of some administrative expenses. Okay, so here is where I have a little video to share. This is going to take me, I'm not an IT expert. So I'm going to try and talk and move it to my video at the same time. But many years ago, I attended a conference for the nonprofit sector, and this gentleman named Dan Pelota was a speaker, and I'd never heard of him. And he had just released a book that is, I don't know if the book or the documentary came first, but there's both. And it's called Uncharitable. And he has a really unique message in the nonprofit sector. I'm going to play the video and then I'll share my thoughts on this thing. Hold on just a moment. Let me reshare here. All right. Going to make sure I can see someone's. Okay, Christina, I'm going to look at you for a nod if the sound is working.
You don't have your screen right now.
Hypnotize people in consumption.
There it goes.
Okay, we'll see.
Yes, and yes, we can hear it.
Okay, all right. It's good if I actually click through the share screen. All right, here we go. Here goes the video. It's just a minute.
You want to know why charities haven't changed the world? We hypnotize people in consumption, and we don't let the nonprofit sector indoctrinate people in compassion.
We have to go beg for every dollar we get. We're still, in fact, businesses. You still have the same operating costs.
We have 2 rule books, one for the nonprofit sector and one for the rest of the economic world. We're trying to address income inequality, climate change, feeding the world the horrors of war. What is a world that works for everyone? What does that world look like? There's this huge distrust with charities.
Breaking news tonight. Questionable spending practices.
The work we're doing to help people has been so mischaracterized, and it gets destroyed. We need to come up with solutions that we can't yet imagine. The next time you're looking at a charity, don't ask about the rate of their overhead. Ask about the scale of their dreams. The most incredible things are possible. You want to know why charity?
Okay, now let's see if I can get back to my slide gracefully. Hold on here. And, oh, is it there? Yes, okay. So the message that Dan Pelota is out there in the world sharing is about the admin allocation. And, you know, as I've been brought up in this sector, I remember initially there's always been this huge focus on, does your admin allocation exceed, or your admin expense exceed 10% of your total, right? So organizations are constantly looking at their statement of functional expenses. Let me switch, whoops, I won't switch yet, to calculate this ratio. And if their admin expenses exceed 10%, sometimes, you know, people think the organization's on fire. And I guess I use this video and I just encourage you to read or watch this documentary, because it doesn't tell the whole story. And I think as I sit on finance committees and work with nonprofits, my encouragement is, let's not put so much focus on this ratio. Important, yes, but is it everything? No. It really goes back to the strategic plan and making sure that your expenses are related to what's going on with your strategic plan. So if you are in a capacity building year, your admin expenses could be higher than normal because you're in a capacity building year. Or you're working on a capital campaign, so your fundraising expenses may be larger in that year than a prior year. So it always tells a story, and as long as we are clear on the story and how that ties to the plan, that feels like good stewardship to me. All right, this next slide is about contingency planning, and I listed on here a few types of funds that I'm sure all of us have heard: reserve fund, rainy day fund, board restricted fund, capital fund project. One thing that all of these funds have in common is that they are all technically unrestricted because they are designated by the organization. So if a donor gives you money and says you have to use this for X, that becomes a restricted fund. But if the board and the leadership of the organization wants to set aside funds for a reserve fund or any of these other things, it's technically unrestricted. And it's up to the board and leadership to decide how much should go into that fund. I did put on here, you know, general best practice is that your reserve or rainy day fund, those tend to be the same thing, have 6 to 12 months of regular operating expenses. And this is not something that most organizations can build overnight or in 1 year or even in 2. So this is a goal to consider of setting that much cash aside as a rainy day or reserve fund, versus a board restricted fund tends to be for a specific purpose, a program you're looking to build, for example. And a capital project fund is for just that. If you're looking to buy a building, tends to be the most common that you would put it aside in that kind of contingency fund. Now, so we've built a budget and we've considered putting what reserve funds we need to set aside. And then the other really important piece here is how we monitor and evaluate that budget. I've got on here an example of a budget to actual variance analysis. And my encouragement is that when we have variances that are plus or minus 10%, that those are the ones that we call out with some explanation. And that we talked about how often should we be doing this. Again, I think it depends on the capacity of the organization, ideally every other month. And then also to be looking at performance metrics, KPIs, and using projections to complement the budget. One thing that I always like to tout to organizations is, let's not redo the budget regularly over the course of a year. Let's have one budget for the year, and as things change, let's update the projections. So we should have running projections that we're reporting out on a regular basis, but not changing the budget. And I also love dashboards. So I've got an example of here of a dashboard. There's a lot of members on boards that don't have a lot of financial acumen. They love graphs. So if you can get stuff into graphs for them, that can be a great way for them to help monitor some of these KPIs. This is a stoplight dashboard. Maybe some of you have seen that has these financial indicators on here and talks about whether green means it's complete or on target, yellow is that it's lagging or delayed, and red is that it has significant delays or setbacks. So lots of folks like to help monitor the financial health by using this stoplight dashboard. And then back to Jason's point about maintaining 5 to 10 year projections, I like to see at least 5, and this is super high level projection. It could be one line for revenue and 3 for expenses. So you can help tell the story of where you think your organization is going to be in 5 years. How many people do you think we're going to have to hire in order to accomplish this level of revenue? And it always ties back to the strategic plan and helps to tell that story. Last piece on this budgeting is key performance indicators. Spoiler alert, I got this list from ChatGPT. I literally typed in ChatGPT, what are some relevant KPIs in the nonprofit sector? And this is part of the list that it pumped out. So I'm not going to go through and read all of these to you, but I would really encourage you to consider the KPIs that are relevant for your organization. Boards love KPIs. So if you can get those snuck into some of your financial reports, it would help, I think, with transparency, accountability, all the things.
How often would you do those KPIs if you were sitting on the board?
I would suggest at least annually. Sometimes, we don't have a lot of capacity to be doing those more frequently, but when you get to a dashboard and you can have a dashboard with your regular board packet, then I would do it on that same cadence. All right, I took up all my time here almost. So are there any questions about this budgeting section?
There was one in the chat a few minutes ago about how to account for volunteers in budgeting, especially when they're a significant part of your kind of workforce and capacity. Obviously, there are different rules, I know, for accounting for them versus using that for planning and budgeting internally. So it's sort of two parts of the question, I would think.
Well, I think so. For internal financial statements, it can absolutely be part of your budget. You could attribute a dollar value to those volunteer hours and get them into your budget with an in-kind income, in-kind expense. And Andrew, this will be a great segue to pass it over to Andrew, because GAAP does not feel the same way, and the 990 does not feel the same way about how we report volunteer hours. But I think getting it into your internal financial statements so that it can be part of the regular reporting that goes to the board is one way to do it. All right, Andrew.
Perfect. All right. So I'm going to talk a little bit about your first audit. It sounds like some of you have probably already gone through an audit before, but maybe some of you are not. Maybe some of you have your first one coming up, or maybe you're just looking for what to expect when the time does come. And so I wanted to just mention our firm, Greenwood Ohlund. We talked about how we have our 3 departments. Our assurance department is exclusively focused right now on audits of small to medium-sized nonprofits. So as I'm discussing these aspects, I'll give our experience, and it's going to be very similar to if most of you are small to medium-sized nonprofits. That's going to be very similar. So you can go to the next slide. I just have a little agenda here on what I'm going to be talking about. First off, understanding why you might need an audit. There's several different people that might ask you to undergo an audit. So if once you've decided that you do need an audit, how do you select your auditor? Once you've selected your auditor, how do you kind of prepare for your audit, prepare for providing documentation? And then what happens once you during the audit and after the audit. And so, yeah, we can go to understanding why you might need an audit slide. So I guess I should just mention, for those of you who've never experienced this, an audit is when an independent firm comes to you and is basically trying to test and look at your balances and your income statement, your balance sheet, and your other financial statements, and they kind of verify their accuracy. And so I'll talk a little bit about more what that looks like from a logistics standpoint on a couple other slides, but just so you know, this is a big process for those who have not gone through it, but definitely doable if you're prepared. So who needs an audit? I've kind of ranked this in order of for our clients, several small to medium-sized nonprofits in the greater Seattle area, what our clients have asked for, or why our clients have needed an audit. First off, your board, this might be a just best practice from your board. Your board might say, I'd like this for financial oversight. Hopefully, it's something we can afford and something that we should be doing. And one thing we present to a lot of boards as part of our audits, and one thing that they really like is, I'll mention, if there's any audit adjustments. And so because you are relying on internal financial statements to make decisions at your board meetings and your management meetings, and then later auditors can look at that information after you've made the decisions based on the numbers. And so that's something that your board might want to see. What was the information we've been making decisions off of? Was that really accurate? And so hopefully the answer is yes. But that's something I always mention when I talk about audit adjustments at a board meeting. These are numbers you've already made decisions on. And so that's one reason your board might want an audit. Another person who might ask for an audit is a grantor or a donor. That's fairly common from what I've seen. A lot of times it's government grantors that ask for an audit. King County is probably the most common that I've seen. They ask for an audit above a certain dollar threshold. Maybe the state of Washington, the city of Seattle might ask for certain audits, or a big donor, or any other grantor. But that's pretty common. The state of Washington actually requires, if you have annually over the last 3 years, if you have an average annual revenue of over $3 million, the state of Washington says you should be getting an audit. And so that's something to keep track of. The federal government, if you receive federal funding, so that's funds that originated at the federal level, could be passed through from King County, state of Washington, whoever. But if they originated at the federal level and you've received and spent over $750,000 of federal funds in a given year, you're required to undergo what's called a single audit, which is a normal financial statement audit in addition to a compliance audit that's specific to the federal funding. And then not as common for us, I would say this is much more common for a for-profit audits. Your bank might require an audit, especially if you have a loan. I would say less than half of the nonprofits we work with have debt, but if you do, and your bank, it's good to check that debt agreement to make sure they're not requiring an audit. But those are kind of the sources we see. So once you've determined you need an audit, the next step is to select an auditor. We've seen all across the scale, we've seen people do this really intense multi-month proposal process, or we've just had someone reach out and say, hey, we heard your name from this so-and-so that we know. We're not talking to any other firms. What would an audit look like with you? And so there's a whole different scale of what you can do. If you know you need an audit, you can go the big proposal process, or you can just go to someone you know. There's pros and cons to both. Factors to consider when you're selecting an auditor, and this is more geared towards if you're looking at multiple firms to do your audit. I didn't put this in any sort of order, but I would say reputation is probably the biggest one for me, and it's not just reputation as in like, oh, this is a big firm in the area. This is a great firm in Seattle. Reputation amongst their clients on the audit experience is really important. So that's why, hopefully if you do send out an RFP for an audit, I would ask for client references, a number of client references that you can call and say, hey, how was your experience with this audit, with this firm? That's, I think, we've had several clients come to us that have just had really, really bad experience in the industry right now. And our industry is dealing with staffing issues and things like that. And it's just caused really bad experiences for some clients. And so that's a big thing to get ahead of before you select an auditor. Experience is a big one. Working with similar organizations, I can tell you that we have been able to create efficiencies by working with such similar organizations, small to medium-sized nonprofits. You have certain firms that specialize in private schools or community organizations, things like that. Even better if you're just diving into your niche and sub niche that you live in. Add-ons, basically, like what else do we get outside of the audit experience? Obviously we do the concentrated audit period every year, but do you offer training a few times a year? Do you offer something like this that we're doing right now? Do you offer, are you at least available for us to ask questions throughout the year? Do you write articles that you can send us? Do you send us articles that other firms write about important things that might affect our operations? All good things to ask. This one, the audit process, I don't see a lot of people asking, what does the process look like with you? How can you give me a step-by-step? What's the timeline of the audit? And it might be different across, the timelines might be different across different firms. One firm might expect you to be kind of in audit mode for 3 or 4 months. One firm might say, we'll have this wrapped up in a month. So that all matters. And then the price, obviously, that's what people look at probably the most. But I would say these other things are really important to look at too. So once you've selected your auditor, the next step is to start preparing for your audit. It might be months away. It might be really coming up quickly, depending on how kind of ahead of the game everyone is on the process. I mentioned at the top, I've been doing this for a little over a decade. And so I remember early on in my career, we were doing an audit of a private school. It was a K-8 school or something. And this was back in the day when we used to go out to the client every 4 days a week, every time we came. That's not necessarily the case anymore for us, at least. And I'm going to talk a little about that on the next slide. But the way we ask for audit documents and the way you provide them is a lot different. When I did that, when I came out, we sent a Word document. Here's what we need, and they sent. They laid out on a big table that like 2 kids would sit at, 20 different piles. Here's each request of papers, and it was probably 200, 300 strips of paper, and I haven't probably seen a physical paper in my hand document for an audit in like 3 years. And so it's different. Everything's different. So understanding the system that you're expected to be working in is really important. We use a document sharing system that's online, and it's really helpful. Each individual request, you can drag and drop files, you can add comments. A lot of firms have systems like this, but understanding that is really important. And even like I mentioned in the audit process, even understanding what it's going to be like, because that can really change your experience. Asking for your list in advance is really helpful. A lot of firms can, if they've said yes to you and you've signed the engagement letter, it doesn't take that. It's not that difficult to send that initial request list to you. And so especially if you're undergoing your first audit and aren't sure what you're going to be asked for, asking for it early can really help, even if you're months in advance, just so you know what to prepare. Especially if you can kind of, as you're closing your year, as you're doing your year-end process, if you can cater that towards what is our auditor going to ask for in a few months, that's really helpful. We as auditors, I believe this is pretty much the case across the board, is that we function really focused on your trial balance. And for those of you who don't know, your trial balance is all your general ledger accounts, debit balances, credit balances. It's kind of just the raw data is compared to like if you're providing an income statement or a balance sheet to your board, that's a little different. These are just the raw data, and making sure that every piece of documentation that you're providing that's financial is tying to that trial balance is going to be really important. If you're focused on, I can't tell you how many times I've gotten an accounts payable aging schedule, for example, and I can't figure out how it ties to the trial balance. So I have to go back and ask about it. So tying that information to the trial balance, that's like the one I would say down in the weeds recommendation I would make if you're going through an audit, is making sure you're just focused on that trial balance, because that's going to make the process easier for everyone. I haven't really talked about a review. A review is a little lower in scope than an audit, but it is still an assurance engagement. And those are definitely, some people ask for that too, similar to the people I talked about in the first slide. An audit, we ask for, an audit and review, we ask for similar documents to start. So we're going to ask for your AP aging schedule. We're going to ask for your bank statements, things like that. With an audit, we go a level deeper. Once we tie out the information to the trial balance, we ask for some third-party support. So we're going to ask for receipts. We're going to ask for invoices for certain documents. We're going to ask for donor letters for some contributions, things like that. And so we don't really do that in a review. A review is focused on analytics and inquiries. And so if you're ever deciding between those two, know that an audit is much more deeper in scope, more expensive, things like that. But it provides greater assurance. And so it depends on what you need, what your needs are, and what your grantors, clients, things like that needs are. And then you're not going to just be asked to provide financial information. It's not just going to be schedules and reconciliations and things like that. Auditors ask for your board roster, your board minutes for the whole year. They're going to ask for your organizational documents, like your bylaws, your articles of incorporation, your tax returns, things like that. And so just be prepared for that as well. So now you're prepared. You've gotten you've provided all the initial requests to your auditor, and your audit date has come up. We schedule usually a week where we are, our 100% focus is on you. We're focused throughout the process from start to finish, but we schedule a week where here's where we're going to do the bulk of the work. And so I think that's pretty common across the board. And so understanding the expectations for that week and for the before and after are really important. When are your documents due? We usually put our initial documents due the week before the audit. And then we put follow-ups due a few days after we request them. Making sure you know that when your auditor is expecting things. In person or virtual, is your audit going to be, do your auditors want to come to your office? Do you want your auditors to come to your office? What's your preference? We as a firm have decided that we're just to continue efficiencies from an assurance department, at least, we are fully virtual. And that we've actually had clients come to us and say, we really would like you to be in person, and we've said no. And so but that's maybe unique to us. I know there are some firms that are going back to clients' offices. And so if you're going through an audit and you would rather be there or not, that's something to touch base on, but well before you do it. Ensuring your staff is available and prepared. One thing that I always used to teach, staff is that you have jobs, you have your real jobs outside of doing an audit this week. And so, making sure to be prepared for that fact is that you have other things to do. I've had people tell me, I can't get this document today. I've got to run payroll. That totally makes sense. And so making sure you're available as you can that week, while still providing realistic expectations to the auditors. I mentioned that, we usually send a batch of initial requests, and then there's going to be a lot of follow-up requests. A lot of those receipts and invoices and donor letters and things like that. And so there could be several requests. So that's something to prepare for during the week of the audit and during the course of the audit. And then just keeping up with timelines and communications. There's nothing worse than someone who just kind of doesn't respond to emails when we're trying to wrap up the audit or trying to get some documentation. And so your auditors are going to be fine if you say, hey, I really have some other things I have to get to over the next few days. I can provide this on this day. But that's really important, so that your auditors don't lose on the timeline. But yeah, it's definitely a big process, a big week to conduct the audit that week. But then after you're done, you'll receive the draft of your financial statement. So it has all your financial statements. First, it has our audit report, which is kind of our section of your financial statements that shows your audit's been completed. We have an opinion in there that says your audit is whether your audit has material misstatements or not. Often the answer is no material misstatements, which is great. If you have any findings, any management letters, a management letter is a formal recommendation letter we can write if we find internal control deficiencies or internal control recommendations. A big part of our audit is gaining an understanding of your internal controls in addition to auditing the numbers. And so if we have recommendations, we can provide it on a formal or informal level, but you should receive those when you receive the draft of the statements. Sometimes we present to the board, but most of the time we do present to the board because auditors have to do some kind of final communication, but it could be a letter if you want. I would say 95% of the time we present to the board on an audit, just because it's nice to have that face-to-face final presentation. And then we finalize the audit, and you can pass it off to you with all the dates, no drafts, watermark, or anything like that, and you can distribute to those who need it. And so that's kind of the process for the audit, for your first audit. I think the next slide is just if you have any questions, but I know that's a lot of information. I don't see any on the chat though, so maybe we're good.
I have one that was sent to me directly that's
Right.
actually pretty specific about
Yeah.
where bank reconciliations fit in with audits, as opposed to just sort of statements and stuff. So like
Right.
the reconciliations themselves and how those get used.
That's a great question. Yeah, bank reconciliations, we probably look at even just as close as statements, if not more, just because the final number on the bank reconciliation is that final number of the trial balance. And so if you have a lot of reconciling items, big significant reconciling item, that changes your cash balance quite a lot. So we definitely take a close look at those and test some of those items if they're significant enough.
And just from a accounting department perspective, cash reconciliation is extremely important and should be done monthly, period.
Yeah. And we will always, if we learn that no one's reviewing those, that's often an internal control recommendation that we provide. It doesn't always rise to that formal management letter level, but we will always recommend that someone whoever's preparing it is someone else is reviewing it.
All right. Any other questions for Andrew?
Well, let me ask this quick question. If you have an organization that has never been audited or has never been asked to be audited, one, maybe because of capacity, or two, because of that the volume of funding or cash it has is below the threshold. So what do that organization do the organization need to keep in place to make sure that it is within financial regulation or within whatever it needs to keep to make sure it is it has a safety nets?
Right. Yeah. I think the stuff that Jason talked about staffing is a big thing. Making sure you have the appropriate staff to do your accounting work, whether it's contract staff, full-time staff, and going to trainings that talk about, there's a whole host of trainings. A good resource is the Washington State Society for CPAs. They provide a lot of trainings for various issues if you're struggling with an accounting issue. But yeah, if you don't need an audit or you're not able to do an audit, those are good starting steps I would take. And a review, like I mentioned, is definitely a cheaper, less intensive option as well. That gives you some assurance, not as much of an audit, but it does give you some assurance.
Good, thank you.
Yeah.
All right, and I'd add to the list, there's always board recruitment, trying to get, someone with some financial acumen onto your board that can help look over those things, and you presumably wouldn't have to pay. So that's always a nice option. All right, we only have 10 minutes left. Time flies when you're having fun. So this last section is about 990s. I'm going to blow through it pretty quickly here to make sure we've got some time for any questions that may be left at the end. So the title of this last section is that Form 990s is more than just the numbers. And so to reiterate that message, I mentioned that I'm on the board for the Mountains to Sound Greenway, and I included their part 3 of their Form 990 on here, which is the Statement of Program Service Accomplishments, or the PSAs. And we spend a lot of time talking to clients about this section, and grantors spend a lot of time reading this section. The IRS spends a lot of time reading this section. This is the place where you get to tell the story of how you accomplish your mission. And we encourage folks to make sure that this page gets updated, specifically the program pieces, which are number 4, that those are getting looked at annually and updated, because this is your place to show off and to reiterate that you are accomplishing your exempt purpose. And so this is unlike any other tax return. You know, we do a lot of for-profit and individual work, which is really about the numbers and people care what their tax due is. And Form 990 is not that. So this is where you are reminding the IRS and the public about why you're an exempt organization. And it is also the place where the IRS makes sure that there's transparency and accountability about the fiduciary responsibility for the organization. So again, I think in addition to the IRS, grantors will look at this to make sure that you're checking. This is part 6 of the form, and this talks about different pieces of governance. One question we get a lot is, I made changes to my bylaws. Do I need to, or to my articles of incorporation, do I need to give a copy to the IRS? And the answer is no, but you do need to check the box on here that you made changes. So there's a lot of considerations and checklists required in this form. And again, it all goes back to accountability. I would just encourage, I would encourage everyone to make sure that you're always reading this part 6 and that it's updated for what's going on in the governance of your organization. And then compensation reporting. This is part 7 of the form. I always like to remind organizations that if you're a fiscal year end, meaning you're not calendar, this form is always on a calendar basis. So this is based on W-2 reporting. And then it also, this column F includes other benefits. So medical benefits get reported here that are paid to staff, as well as retirement contributions. So sometimes those are things that get missed in column F. But in the interest of disclosure and accountability and transparency, it's important to get this schedule right. And then this is just a friendly reminder from your local CPA that the 990s are due 4.5 months after the end of your fiscal year end. So for a calendar year organization, that's May 15th. If you're a 6/30 year end, that's November 15th. And you can always get a 6-month extension. I listed on here the form types based on revenue. So if your revenue is under 50K on average, you can file what's called a 990N. It's a postcard filing. It's basically a 1-line form just to remind the IRS you still exist and to keep your exempt status. If you're under 200K, you get to file a 990EZ, which is not easy, but is a little shorter than a full form 990. And then if you're over 200, you're into the full form and there's a lot of disclosure. And just one pro tip here is that sometimes these forms get filed late. So for whole host of reasons, you may miss an extension or you may miss getting filed on time. And the IRS, in my experience, will abate the late filing penalties pretty much 100% of the time. And I know I'm being recorded, so it's probably going to happen now that someone's going to say, no, I've had this experience. But in all the abatement requests that we've written, we've always seen it be abated. The IRS does not tend to hold these penalties. So if for some reason your form is late, don't pay those penalties and make sure you reach out to the IRS and file for abatement. And then my last slide here is about the statement of functional expenses. And this hopefully ties some of these things together. This report, the statement of functional expenses is in the 990. It's also in your audit. We also talked about it in the context of Dan Pelota and his message about comparing program versus management versus fundraising expenses. And I think, yes, the IRS looks at this. If you have 100% administrative expense year over year over year, they're going to come knocking. So it is something that we need to pay attention to. But again, the message here is to just make sure that this is always tying back to the strategic plan of your organization so that it tells your story. Nice and quick. So this last slide here is just our Q&A. I'm going to leave this up for a second. This has our general email. I thought this would be easier than trying to give all 3 of our email addresses, even though they're just our first name at Greenwood CPA. But you can email info@Greenwood CPA, and that message will make its way to the right person to answer your question if you have any follow-ups. So we're super grateful for the opportunity to come today, chat with all of you about our favorite topic, financial stewardship. Are there any, I'm going to stop sharing my screen so we can see each other's faces if you're sharing. Are there any other questions in our last 3 minutes?
I did get one other one sent to me for you, actually, back on the budgeting piece, which I thought was a good question, which is how do you take depreciation into account in your budget planning?
Ooh, good one. Well, I think I like to have the budget match what the financial statements are going to look like. So my preliminary recommendation is that you budget with actual depreciation. We calculate it, that's what goes into the budget. But I also think it's super relevant to have what's more reflective of a cash flow budget. So, you know, if you're buying a van, pretty common example in a given year, and so you want to make sure that you're going to spend 30 grand. I don't know how much a van costs these days. I'm making that up. 30 grand on a van, then you're going to have a budget that reflects the cash that if you're going to pay cash for it. And then you also determine what the depreciation is going to be. So you're really maintaining more of a cash flow budget and then an actual budget, which will match your financial statements.
And I also see that you can back in and out the actual capital expenditures for the year. So another way to think about it is some organizations like to actually fund a PRISM fund, which is another way of saying a 5-year procurement cycle capital expenditures fund. So that's one other way to like track it from a cash flow perspective, because it's depreciation, but at some point you're going to have to reuse or do a capital expenditure again.
Look at us, 1 minute left. Any other questions?
Yeah, hello.
Yes, go ahead.
Yeah, so if you happen to go through an audit with one of your funders, and let's say in a year or so you hit 3 million, and that qualifies you for an audit, and let's say 3 million from federal funds. So would you still be audited by the federal government, given that you have already been audited by one of your funders, let's say a year or two prior?
That's a good question. So when I was talking about audits, I'm mainly talking about audited by an independent firm like ours, or there's several of them out there. And so the federal government, if you receive federal funding, the federal government does not really do those audits. They are just saying you are recommended to go, or you are supposed to go to an independent firm and do that audit. I would assume that's the same with a grantor, although every grantor could be different. And so in the case that you lay out, I would just recommend, if your grantor requests an audit from an independent firm, use that firm, and then use whatever firm you choose. And then if you subsequently need a single audit because of the federal funding, you could use a firm who does those federal audits. Did that answer your question?
Yeah, thank you.
Great.
All right, well, I was gonna say we're at 11:31. So if there are no other last questions, you have contact info for both Greenwood Ohlund and PHPDA in the chat. And thank you all for coming. And really thank you so much to Greenwood Ohlund for doing this.
Thank you for having us.
You'll get a survey, and the slides and the video will all be sent out soon.
Thank you. It was a good meeting.
All right, great.